Well, to begin with, the ratings agency Fitch has revised Ghana's outlook to negative, but affirms B ratings. The revision of the outlook to negative reflects the significant deterioration in public finances stemming from the COVID-19 pandemic and the delays to government's fiscal consolidation efforts, which reduce government's ability to absorb further shocks for an extended period. Moreover, it said the lack of a clear majority in Parliament following the December 2020 elections increases the risk of fiscal slippages. The B rating reflects the high public debt level and low revenue base, which means that Ghana's debt affordability metrics will remain markedly weaker than rating peers over the horizon. Now, this is balanced against Fitch's expectation of a recovery in economic performance and stabilization of debt to gross domestic product. Well, joining us to discuss this further is Professor Eric Osei-Sibe, who is an economist. Great to have you, sir, on the program this afternoon. First, explain to our audience what this downgrade means from B stable to negative. Okay, we'll re-establish connection with Professor Eric Osei-Sibe once we get to him. But some news developing this afternoon as well. Governor of the Bank of Ghana, Dr. Ernest Addison, has provided detailed response to the reasons the central bank would not appear before the parliamentary committee to answer a petition by some shareholders of defunct UT and Unibank. Now, according to him, one of the main reasons is to allow the legal proceedings to flow smoothly, since some of the shareholders have already slowed the process with many countersuits. Now, speaking at the Chamber of Commerce and Industries Business Forum in Accra, Dr. Addison called for public support for receivers to be able to retrieve all properties of defunct financial firms. Okay, so I'm told that we can speak with Professor Eric Osei-Sibe, who is an economist, on the story we're telling you about Fitch downgrading Ghana from a B stable to a negative. Please explain to us what this downgrade means from B stable to negative.
Thank you. Thank you. Yes, can you hear me?
Loud and clear.
All right, great. Yes, so what this downgrade mean, or what the downgrade mean, is that it's going to have an impact on the country's ability to service its loan, which then means that investors often will see this country as a much riskier bet, and therefore will demand a higher returns on lending to government. But with the specific issue of what the report that Fitch put out, it is actually not a downgrade. Moving from a stable outlook to a negative outlook is not moving from one grade to the other. So we cannot describe it as a downgrade. It is a situation where the rating agency is trying to say that if nothing is done, government's position or a position of a B can slide down to a downgrade to say a C. So we are not yet being downgraded. The outlook has changed from a stable outlook to a negative outlook, which of course gives warning to government that if certain measures are not put in place, there is going to be a downgrade in the next review. So that is what it means. And what that means is that it obviously causes investors to be on the lookout and to be cautious when lending to government, because government can slide, or the grading can slide to a C if certain measures are not put in place. So basically, that is what it means.
Now, the reason cited for this revision has to do with the deterioration of our public finances. I mean, the key word for me is deterioration, which means that we are apparently struggling to fix some of our shortfalls. It tends to suggest that government doesn't have a hang of things. Does that appear to you, same?
Well, not necessarily. We all know where we are coming from after the pandemic, which actually led to a drastic fall in revenue and a ramp up in expenditure as a result of COVID related expenses. And this is not new to Ghana. It's not something that is unique to Ghana. All over the world today, countries are actually experiencing a very fast growth in fiscal deficits, largely because of the disruptions of the COVID. And therefore, for me, I don't think that it is a cause for alarm because obviously government need time to recover from this shock. And my thinking is that the report, in my view, has been a little bit harsh on government. If you read it in its entirety, it makes a point that government fiscal consolidation has slowed, and for that reason, the negative outlook. Of course, this they have done the same to many countries across the globe, even including countries like UK and others, which have experienced some downgrades. But in my view, given that this shock is really very deep and really shook the entire foundation of the economy, countries need time to recover. And not until the recovery is fully materialized, I do not think that fiscal consolidation is more important. I think any move for government to immediately fiscally consolidate can derail the process of recovery. And in my view, I think that even government in the last budget actually speed up the pace of fiscal consolidation, which, if you ask me, I thought that it was far too quick. I think that government should still continue to use fiscal and monetary policy to support businesses until such a time that we experience full recovery. Then it will begin to commit more resources to fiscally consolidate. That is what I believe. And so the whole idea that the fiscal consolidation has slowed just at the time when we are just recovering from this pandemic, I do not think it's a fair assessment of the situation.
All right. Talk to us a bit more about the repercussions of this on us. I know, for one, I mean, you also mentioned it, how this affects investor confidence. What does it do to our efforts at post-COVID-19 economic recovery?
Well, I mean, it can have a detrimental effect, but in my view, it also means nothing. I mean, if you ask me, in the sense that often in a crisis period like that, where all countries are experiencing some form of deterioration, and when you experience such a downgrade, the effect is quite minimal. Normally, such effect will trigger two things. One is that the interest on your borrowing will increase. So investors, because of the higher risk, they will demand much more interest rate to cover any risk premium. And then also it's likely to trigger sell-off, where debt holders or equity holders will begin to sell off your debt. And that can have implication on your repayment, debt repayment ability, as well as your exchange rate can also depreciate. But in this case, the downgrade is happening in many countries across the globe. It is not only Ghana. So many countries which have recorded fast accumulation of debts and large fiscal deficits have been downgraded. And so there are not much options for investors at this time around. So I do not see much negative effects on the economy, given that the timing or the fact that many countries are now recovering and countries actually are experiencing difficult economic situations. So in the past, obviously, would have triggered some kind of sell-off. Sell-off means that people will offload the debts that they are holding, and that can mean that a high demand for the foreign currency and lead to some depreciation of the currency, which of course will have some macroeconomic instability in the country. But this is not likely to be the case because you don't have much choice around this time.
So we've talked about the impact of COVID-19 on the review that we are seeing from Fitch, but there are some suggestions that the economy started deteriorating even before COVID-19. So is the outlook really based on this?
Well, I'm not sure the assertion that the economy started deteriorating. I don't think the data available supports that because, prior to the COVID, we have recorded a fiscal deficit below 5%. Inflation was on a downtrend, and there was some form of, debt stabilization. Of course, we may talk about the two key shocks that actually led to a steep rise in the debts, the legacy debts from the energy sector, that is the contingent liabilities that were taken from the energy sector, and then also the financial sector cleanup. That, of course, led to some uptick in the debts overhang. But of course, all other indicators pointed to the right direction prior to the COVID period. I think the COVID actually aggravated the situation that occasioned from the financial sector cleanup, and then also the contingent liabilities that were occasioned from the energy sector. But the economy was doing well. So I do not see this report largely being based on the prior economic situation. I think it's post-COVID situation. And the COVID situation, as I mentioned earlier, is the one that has resulted in significant fall in revenue and large increase in expenditure, which obviously will lead to large fiscal deficit and, of course, debt levels increasing. That obviously will not give you a good outlook. And so it is quite fair that there's been a downward outlook in terms of giving it a negative. But to say that government is not physically consolidating, for me, I don't subscribe to that viewpoint, because also, if you remember, the budget that was announced actually introduced some taxes, of which many people have complained that the taxes were just too burdensome for the economy. And this is a sign of fiscal consolidation. Government also actually reduced expenditure and is looking to reduce fiscal deficit to about 9%, which is quite drastic.
All right.
My view is that we shouldn't rush to fiscal consolidation at this time. The focus should now be more on recovery. Government should look to recovery and ensure that we fully recover before any drastic fiscal consolidation. Otherwise, it can be counterproductive, which may reverse all the gains that we are currently experiencing with the recovery. I think what is important now is there should still be fiscal stimulus. Monetary policy should still support the economy by reducing the monetary policy rate further down to ensure that the lending rates and interest rates come down to support the private sector to invest to speed up our recovery. That is my view.
Great. I just want to pick your thoughts quickly on our debt situation. As we now know it, the World Bank and IMF are finalizing their assessment of debt sustainability. Of course, that is contributing to whatever review we are seeing from Fitch. I want you to listen to the World Bank Country Director, Pierre Laporte, who has been raising concerns about increasing debt.
That situation has reached about 78%, the GDP ratio. Yes, it's going on the high side. Ghana, we've said, is a country at risk of high risk of debt distress. But we know it also happened, it was exacerbated by COVID. Before COVID, the ratio was well below 70%. So, yeah, I mean, government has to come back down to a lower deficit level as soon as possible. We know that the fiscal responsibility law was, suspended. Rightly so. I would have done the same, But the soonest government can come through a lower deficit level, it can start repaying some of the debt. The faster the economy can grow will also help the situation. So, and more stability in terms of commodity prices worldwide will also help cushion against shocks. Revenue is not enough. 12% debt GDP ratio is not good enough for Ghana. I mean, the minister is aware. We discuss all the time. He's recently put in place some measures to raise some revenues, but we believe there are areas like widespread exemptions that the government needs to tackle, and more efficient collection, like through digitalization and other means, should help that.
On our debt sustainability analysis, when are we up for review?
Actually, there's one underway now. It will come out very soon. The bank and the IMF are just finalizing the assumptions and the last picking up the data.
Looking good for us?
No, but it will not say very much different from what it is now. I mean, the situation is not going to be much worse, and we all know now. So,
growth projections optimistic?
Yeah, we've seen Ghana seem to be growing faster than the rest of the region and faster than predicted. We're predicting about 4.5% as early as this year and over the medium term.
Yeah, Laporte wouldn't say much, Prof. I just have about a minute with you. What's your gut feeling about how this would turn out? We are told that we could possibly be pushed into the dreaded debt distress status.
Well, it's a possibility. I mean, given the projections that have been made, that debt to GDP is likely to hit around 81%. Of course, that would be within the distress zone. But I'm not too worried. If you look at the current data that was reported, I mean, our growth trajectory has been very positive. We are recording one of the fastest economic growth across the globe. And so if you maintain that momentum, we are likely to reduce the debt to GDP going forward. My advice to government will be that we have to perhaps shift gear, change focus from our concentration on commercial and private loans to a more concessionary and then traditional form of loans and grants and concessional loans to reduce cost of loan servicing. I also think that government should rethink its stance on the debt suspension initiative. I think that it's something that comes in handy for government to take advantage of and to see to some kind of debt relief to reduce fiscal pressures at this time, to allow for more expenditure into the social safety nets and then infrastructure. Otherwise, it's definitely going to crowd out government ability to spend on the critical sectors of the economy, especially on infrastructure and on the social sectors, namely education and health. And so I believe that government should take advantage of the debt service suspension initiative and try to apply for some form of debt relief to reduce the interest payment, which is currently around 45% of revenue, which of course that is not a sustainable stand. And so I believe that something has to be done with that. And we're reducing borrowing from the commercial and private markets to more on the traditional concessionary and grant form of borrowing to give some kind of fiscal space for more domestic investments on social and economic sectors.
Fingers crossed. Thanks so much, Professor Eric Osei-Sibe, for your time this afternoon. We really appreciate it. I want to take you back to the story we're telling you about, the governor of the central bank, once again defending reasons they rejected calls by Parliament to assist with a probe into the collapse of UT and Unibank. Listen to him speak to us.
Receivers' asset recovery efforts, including chasing those who borrowed money, and shareholders of these defunct banks and SDIs who took loans and advances from them and never paid back has been frustrated, especially through the use of the court system. Some of these court proceedings have been delayed by shareholders who have tried to use unwarranted challenges to the statutory powers of the Bank of Ghana and the receivers to frustrate all attempts to hold them accountable for the mismanagement of depositor funds. Fortunately, just yesterday, we have had unfavorable court ruling that the receiver has the capacity to testify in the criminal case against one of the shareholders. The relevant laws provide for redress for persons who feel aggrieved by the exercise of the Bank of Ghana of its statutory powers. And while there are laid down procedures prescribed by the law to seek redress, these laws are not intended to subvert the cause of justice for depositors and taxpayers whose funds were used by government to pay for depositor claims. While I'm on this, I might add that running to Parliament to seek redress for the revocation of an institution's license is not one of the processes laid down under law for those who feel aggrieved by a license revocation by the Bank of Ghana. There are already a number of actions filed in court and at arbitration by the same persons who run to Parliament for cover. And the Bank of Ghana's simple response to Parliament is respectfully to allow the pending legal processes to run their course. Indeed, sometime in September 2018, the 7th Parliament undertook a formal inquiry into the financial sector cleanup, the factors that led to it, and the manner in which it was carried out. Among other things, the Finance Committee of Parliament invited all the key actors, such as the Ministry of Finance, the Bank of Ghana, the shareholders of the defunct institutions, the receivers, to appear before it and to answer specific questions aimed at assisting the committee to understand the events surrounding the cleanup exercise. The Bank of Ghana cooperated fully with the committee and provided all the information needed to assist the members reach their own conclusions. We had hoped that the committee would make its report available to the House and to the public after its deliberations, but we haven't heard anything since then. We understand Parliament's continued interest in the cleanup exercise, especially given the public funds that were used to settle depositor claims in order to promote the stability of our financial system. While the legal processes in court and at arbitration run their course, we would respectfully ask Parliament, and indeed all Ghanaians, to take a serious view of the 19 billion cedis Ghana government had paid to provide the taxpayers' money to settle claims of depositors, following the mismanagement and siphoning out of several billions of Ghanaian cedis from the defunct banking institutions and SDIs by their shareholders.
Governor of the Central Bank, Dr. Ernest Addison, addressing a business forum by the Ghana National Chamber of Commerce and Industry. We are taking a short break just to catch our breath. When we come back, AGI saying it is optimistic of non-traditional exports worth 25 billion cedis in the next 10 years. Our final story this afternoon brings a lot of hope. The Association of Ghana Industry saying it is optimistic of non-traditional exports worth $25 billion in the next 10 years. Currently, industries under the association are registering non-traditional export earnings hovering around $5 billion. But according to Chief Executive of the AGI, Sechima Kwabwa, the ambitious target can be realized if government creates an enabling environment for the industrial sector to thrive. He spoke at the FBN at 25 National Trade Forum on the theme promoting trade between Ghana and the rest of the world.
We know that the traditional exports has always been there, and that we've been doing quite well. But we all agree that if you really want to make good impact on exports, then we must do the non-traditional. and a lot of effort is going in. But I think if you monitor the data over the years, we've always had a target of doing about 5 billion. It's taken quite a while to even reach that target. Now government has even a more ambitious plan, because we are doing a lot more in terms of vehicle assembling and all that. So hopefully in the next 5 to 10 years, we are targeting 25 billion.
And that's the Marketplace this afternoon. My name is Darryl Kwao. Thanks for watching.